Welcome to Your Financial Journey, where we discuss everything financial, leading you to your future destination. Good evening, and welcome to the COVID-19 Investor Update number 3. So we are in the third week. Actually, it's a lot longer than that, but third week since we've been doing the updates, and I have appreciated greatly the feedback that many of you have given. We're going to actually do a couple of things tonight a little bit differently as resulting from some of that feedback. So please feel free to share anytime things we can do to make this better, things we can do to make this so it works well for you. And we even have a question that came in just today that we're going to take some time to answer. So if between now and update number 4 you think of some questions, please feel free to email us those, and we will definitely spend some time on those for you. As always, we've got the disclosures that are on some of the slides, just basically identifying that we can only tell you what we know at the point. We can make observations, even take a look at some of the information going forward, and try to make best decisions from that. But like everybody on this call, including me and Paul, we only can just figure out basic information on this. We can extrapolate it out in the future a bit, but we're all trying to make the best decisions with information that we're getting, each of us. As a reminder, you all are set up for online chat that you can do questions. And if you get a question during the webinar, please feel free to write the question in the chat. It will show up there, and at the end, I will go through those questions. For those of you who are a little nervous that somebody might read your question, nobody can see your questions except me. And so I will be happy to take a look at those and see what we can answer. If I cannot answer it in this webinar, we will either A, get back to you on it, or talk about it in the next webinar. So please go to the online chat, and in the Q&A session, we will talk about whatever question you had. The preview for tonight, we're going to take a look at the economic perspective, some of the potential impacts of COVID-19, 4 phases to get back to normal, market recovery types, economic and market considerations, the cyclical nature of investing, diversified wealth management, SMART goals to make the most of today or tomorrow, 2020 CARES Act update, and your risk and reward discussion. The economic perspective I've shared every single meeting, and I probably will share it consistently every time, because I think it's important to remember this, especially in light of the fact of what COVID represents. I was visiting with somebody today, and they said, this isn't like anything else. And it's really not true. It is like other things. For instance, economic uncertainty is certain. Doesn't matter what we think is happening, whether it is a pandemic, a collapse from bonds and mortgage bonds, a collapse because of a terrorist attack, whatever the case, it's important to recognize that economic uncertainty is certain. Economic prosperity is only identifiable in retrospect. It would be great if we could figure everything out ahead of time. I mean it seriously. It'd be awesome if we could, but we can't. We can do our very best to try to look at what's going on, make good decisions with the data we have, and make good effort to go forward wisely. But economic prosperity is often just seen after the fact. Economic cycles are typical and should be expected. And so when you hear me talking about the nature of the cyclical nature of investing, peaks and troughs, it is because we're constantly trying to work on that, and I'm going to show you some new data for that tonight. The future cannot be predicted. I wish it could, and there's some people that think they can. I cannot any more than you can, but we can make good decisions with the data that we have. And then finally, having investments is not a goal. Investments are a tool used to accomplish your goals, and that's what we're going to do, is take a look at how to accomplish your goals, and we're going to talk about that a little bit more tonight as well. So, an update on some of the impacts upon our society and the economy. One, the news appears to be slightly better as the virus spreads around the world. China seems to be coming out of some of it, if all that data can be believed. Well, we hear that Italy is having a downturn in some of their deaths and cases are being reported, and we see some other areas that look better. Not all spots, but some. News appears to be slightly worse as the virus spreads in the U.S. over the next few weeks. We've heard countless, the president plus part of the COVID team that he's put together talk about how this week and next week are probably going to be pretty bad. We don't know what that means, but for the moment, we're accepting that that's what's going to happen. Currently, the length of time the virus will be with us appears to be extending. The expectation was by Easter we would be done, and then it got changed to by the end of the month it would be done. And I hear some places they're talking about May, and I hear one place is even talking about June. That we don't know yet. I think as more data comes in, we'll be able to get a better answer on that. But for now, that's what we know. The U.S. has more than 368,000 confirmed cases of coronavirus and nearly 11,000 deaths at this point. Don't know what that number is going to look like next week. And obviously, I think this is an area where we should pray for people because it could be worse. But again, it will also give us a lot more information as we go forward. Social distancing seems to help slow the spread of the virus as we avoid travel, entertainment, restaurants, and bars trying to just stay healthy. It's estimated that 310 million people are currently under a stay-at-home order. We here in Florida are at a stay-at-home order. We're supposed to stay home. Only essential work is supposed to be done. I sometimes see that. In other places, I don't see it. But that's what it is right now. About 310 million people are supposed to be staying home. Social distancing is causing many people to withdraw from the economy. We're going to talk more about that tonight because in some ways that's not accurate, but we do see it happening. And it's estimated that 60% of the U.S. business capacity is currently being utilized. Or another way to say that is 40% of the U.S. business capacity is just out there doing nothing right now compared to what we normally experience. This will lead to smaller businesses closing and larger businesses furloughing, laying off, and terminating employees. The CARES Act has been enacted and is starting to be implemented. We saw that last week, but we're starting to see the ramifications of that this week as we're listening to businesses trying to borrow money, hearing a lot of good stories, but hearing a few challenging stories. But it appears that the banks and the government are working very hard to try to work through that process as quickly as possible, which will have a lot of value as we go forward. No amount of fiscal stimulus will get people back to restaurants, entertainment, and travel. And that is true. We're going to talk about the new normal or what normal looks like going forward. We had an unemployment report last week, and it said that unemployment is at 4.4%, but that didn't count a lot of what's coming. It's currently estimated that unemployment's about 10 to 15% right now by the end of this month. And Secretary Mnuchin thought it could be as high as 20%. We'll have to wait and see, but obviously that'll be a pretty big number when it does come up, when we actually get to see that information. As I've said before, the Fed continues to aggressively create liquidity in the banking system to protect credit availability, which is necessary to create liquidity and velocity of money to keep the economy working. These actions may not curb the immediate impact on business revenues and income for the next 3 or even 4 quarters, but it will certainly help. As compared to doing nothing, it will help improve things significantly, but it still is going to create some more difficult numbers, as we'll talk about as well. The U.S. will likely go through a recession in the second quarter and possibly the third and maybe even the fourth. But again, we'll talk about that as well, show you some data that we now have. And then finally, as I've been saying every week, whatever we think we know today quickly becomes outdated. I've been talking with people here for the last 3 weeks, and everybody, when I say that, they laugh because the truth is we know that new information is constantly changing everything. I also shared this with you before, but I think it's worth reminding you regarding the economy. We expect a very sharp, but hopefully short-lived market contraction. We, regarding the market, expect market pricing in much of this contraction, but will likely go lower before a rebound. We have been watching a lot of volatility where we can tell that the market is trying to figure out what the price is for, say, the S&P 500 or the Dow or the Russell 2000. We see it going down because it's reacting out of fear. We see it going up because it thinks it has priced too low and is trying to recapture some of that. But it is doing what it always does, which is trying to price in what it thinks is going to happen, looking forward anywhere from 90 to 180 days. And continued to say before, history suggests it's still not too late to protect or adjust investment portfolios, whether you are of a mind that there's great opportunity and you want to take advantage of that, or you're of a mind that your concern is going to go lower and you want to protect against that. It's still not too late to operate with some of that, especially as we've watched the good market reaction this last week. There might be some option. If you think you wanted to get out a little sooner, you certainly could. and still talk about doing that. For many of you who are using the third-party management we use with AssetMark, you've already been moved back to more conservative positions. And as I've been talking with you in the last few weeks, it's had good value. You've been pleased that you weren't as down as much as the market was. Having said that, though, there may be some more of that, and again, we can talk more on that concept or that issue if you want to. Some additional considerations, please avoid making emotional decisions. I know it's tempting when there's a lot of things going on, but avoid that as much as possible. Utilize clear and detailed strategies for entering and exiting investment positions. I'm proud of you all. I have to tell you, you've all had great conversations when we talked about entry and exit strategies. So keep up the good work with that. Investors could use this time to review their risk appetite in light of current conditions to make sure that your portfolio is invested according to your risk tolerance. And for those of you with a higher risk tolerance, you should carefully consider all options before buying early in this market decline. We're a little bit early in the process. There's going to be some opportunities, and we can talk more about that. As a matter of fact, we will. So part of the goal tonight is to kind of begin thinking about what it's going to take to get back to normal. And in looking at this market and this economy, there's basically going to be 4 primary phases to get back to normal. Within each of those phases will probably be little phases, little steps along the way. But these 4 primary phases are: 1, the government says it's safe to resume normal life. That'll be the first thing. And as you can see, I've got it way back here, back at the beginning, because the government hasn't said that, not with 310 million people told to stay home and be safe. But sooner or later, they're going to say that to us. And when they do say that to us, we move to the next phase, and that'll be where people feel safe to resume normal life. The fact is that even if the government says it, there's going to be a lot of people who will say, I'm not ready yet. I don't know if I have confidence yet. There'll be some who will go out. They're the early adopters. They're ready to get going. There'll be others who won't be. And we will get through that phase when most everybody says, I feel good now, I can go out. As people start going out and conducting business again, what we find is that business starts to operate normally again. But it won't be just you turn on a switch and bang, everything's back to normal. It'll be a process. It'll be bringing on staff. It'll be getting goods up. It'll be getting food in restaurants. It'll be working on various pieces that'll be necessary to get business to begin operating normally. But then as that continues on, as more people come out, as business starts to operate more normally, as that process kind of builds on itself, phase 4 is when business operates at its normal capacity again, what it was in January or December of last year. That's when we're back to normal. And whether or not that takes us 1 quarter or 3 or 4 or 5 quarters, it will take that time to work through that phase, and it won't just happen overnight. We've got to be prepared for that thought process. But I will tell you this, the market will react sooner than the economy does, because the market is always forward-looking. It's always trying to figure out over the next 90 to 180 days, what is the opportunity that we can take advantage of to grow wealth. So even when we are back here in phase 2 or phase 3, the market may start to show positive growth through that process because it will start to get prepared for getting into phase 3 and phase 4. So even though this may take a while, we might find the market will take less time as we try to get back to normal again. I shared with you last time the shapes of market recovery. A V shape, meaning we sharp down, sharp back up again. A U shape, sharp down, we flounder around with volatility for a while, and then we have a sharp recovery. A W, it goes down, comes back up, but loses it again, and then heads back up again. Or an L, meaning that it goes down and stays down for a long time. I'm comfortable it's not going to be an L. I am relatively certain it's not going to be a W, but I will tell you what I think the issue for the W would be is that if we come out of stay-at-home too soon and we start to have more an increase in coronavirus infections, I think that could create that W. But it seems like everybody is trying to work hard to not make that happen, to keep that from happening. So I think probably we're looking at a V or a U, and I think more likely it's going to be the U, but we will see. We are watching, and as you'll see tonight, some of the tools we're using to help make that determination as we help you figure out how to grow your wealth and keep your family working well. So now, tonight I want to share another thought. It's something that we've talked about in past market downturns, but as good as things have been going, we haven't really touched on this a lot lately, but it bears repeating at this point. There are a lot of items that we can look at to determine our economy. Many of them are lagging indicators, meaning they're indicators that come after the fact. But there are at least 4 primary engines of economic growth, which are leading indicators, and those are interest rates, unemployment rates, business profitability, and GDP growth. When you have good interest rate modeling, and low interest rates or reasonable interest rates, when you have good unemployment numbers, when you have good business profitability, and when you have good national GDP growth, you will have a burgeoning economy. You will have a powerful economy. Honestly, that's what we've experienced for the last couple of years. We've had all 4 of those engines running at full speed, and it's felt great. As we're going to see here, when we go through the coronavirus process, those might change a bit, and when they turn back on again, it will start to feel the same again. But those are going to be the 4 things to sort of keep your eyes on as we go forward here. I shared this last time, and I'm only showing it this time for one piece again, which is that I've showed this chart the previous 2 times. I added this information to give you a comparison of what the October 07 to March 09 Great Recession looked like, how we had the 17-month period of time it took for that to go through, breaking that into 4 quarters, which is basically a little over 4 months per quarter, and then a 57% decline, which is what happened from peak to trough. Breaking that up, that meant in the first 4 months we had about a 16% loss. The next 2 months we had about a 7.5% loss, but it was in the 4th quarter when a concept called capitulation kicks in, that everybody sort of gets tired and gets done and can't take it, and the market just kind of gives up for a while. That usually is the beginning of the end, but that's pretty powerful, in this case, that last 4 months, because it just feels like everything is going to fall apart and never work again. But that's where things start to change. And so when we looked at that, again, as I showed you in previous updates, the length of time for the average market downturn was about 15 months. And when we take a look at some more factors tonight, you'll see that actually there really is a lot of good data that really supports this particular process happening faster as we move through normal back to health again. I think you'll find how this all comes together well. Again, for some of the new people that are on the call, I just want to share this again because from our viewpoint, protecting the downside is critical, and it's really simple. If a person has a $100,000 investment and the market falls 25%, that means their account goes to $75,000. In order for them to get back to $100,000, they have to have a 33% return to get back up, because this performance is based off the $75,000. So it takes 33% on $75,000 to get back up to 100 again, or back to 0. A small hole is easier to get out of, though. For instance, a 50% downturn takes a $100,000 portfolio, moves it to $50,000, but it takes a 100%, 3 times the performance to get back to 0. It's one of the reasons why protecting your portfolio in downturns is critical, and allowing it to work for itself in the upside gives you great opportunity on an easier, more manageable basis. We talked about the cyclical nature of investing, the peak, early downturn, the trough, early upswing, and then upswing. And as I've shared with you before, we're going to talk about how each investment has its modeling. But in this case, just understand, we're going to think of peak as 12 o'clock, we're going to think of trough as 6 o'clock, and then these work on down through the numbers, just like the old-fashioned clocks with the numbers you might even have hanging on your wall right now. The various investment groups that we talk about, cash reserves, bonds, stocks or equities, real estate, tangibles like energy, gold, etc., and business interests, and then insurance and annuities, which are a modeling of these various assets depending on how they're invested, whether they're fixed or variable or not. But what I want to do tonight is just spend a moment on business interests as its cyclical nature and the stock market as its cyclical nature, and sort of give you a little inside baseball on how we're seeing it as we go forward. So for instance, if you think about business interests, and I share with you the clock, up here's the peak, 6 is the trough. 1 is early downturn, 2, 3, 4 into downturn, into the trough, early upswing, and so on. Right now, and nobody can know this for sure, I wish I could point and go, we're definitely at 1 or we're definitely at 3. We don't know. It really depends on how fast things happen. But we are somewhere between 3 and 4 right now. on this model. I'm sorry, 1 and 4 on this modeling, meaning that we don't know how far businesses have gone down so far. We've heard stories that as much as 25% of businesses may not be able to come back when we open the doors and the social distancing is stopped. But that may not be true. The government stimulus program is doing a better than expected job. And so quite honestly, that money that's out there, whether it is unemployment money or it is business loans that can be forgiven to small businesses, those pieces may be working very well. And so until we get more experience, more data, it's going to be hard to say where we are in this process yet. So I think we're definitely at least in early downturn. We may be farther, which means that we're going to hit the trough sooner, which means we could bounce up faster. But again, it's going to take more time because information is changing rapidly around us. When we look at the stock market, because business is going to be sort of a direct reflection on that, what we estimate right now is that we're between 1 and 3, either early downturn or downturn. And that has to do with the fact of the recent market drop back in March may be that place where we see it's not going to go any lower, but it may not be either. And so we're going to talk about some of that tonight as well. When we're looking at different asset groups, whether it's any one of those 7 that I showed you, we're constantly considering where we are in the peak and trough cycle, because that helps us decide when we should get in or get out and make adjustments. So with that in mind, that economic engine that I was showing you on Air Force One, before COVID-19, I would say easily, you could see that we had a good interest rate model. Interest rates were low. We had a good unemployment model. Unemployment rates were low. We had great business profitability. Businesses were making money and were growing. And we had an excellent GDP growth. All of those things were working very well. And so that gave a lot of hope going forward. That's why everybody was surprised when COVID-19 really became the big issue. And quite honestly, I think even people today are still surprised at this. I think more and more people are realizing how dangerous this really is. But still, it's kind of hard to put it all together. So what I decided to share with you is how we see things going forward over the next 2 quarters. We believe interest rates are going to stay low because it seems like the Fed is working very hard to keep interest rates low for that velocity of money and the liquidity for money. But it becomes obvious what I shared a moment ago, unemployment rates are going to go up. Now, everybody expects them to go up. It's not a surprise they're going to go up. But I don't know that anybody on this call has ever seen unemployment rates at 20% before. And I think that will be a remarkable moment when we realize that's the case. It may be that the markets have already counted that in and already priced that into it, but we won't know yet until we get a little bit further down the road. Same thing true with business profitability. I'm going to show you some numbers on expectations for that in a moment, but the reality is we've had 3 really good years where we saw businesses making money, and for the next 2, maybe 3 quarters, we're not going to see that. And that's going to be a challenge for people as we go forward. Again, is that priced in? We're about to find out, but it is something to be aware of until we get a little bit further down the road with a little more information. And finally, GDP growth rate. I know that we've experienced a 3 or close to 3 or plus 3 at different times on growth of the gross domestic product or GDP, but it's probably not going to be the case for the next few months, or the next few quarters, I mean. So those 3 engines are basically going to be turned off or really hampered. So in essence, we'll be flying with 1 engine holding the plane up. Good news is that can work, but it can't work for long. And so we want to make sure that we restart these other engines as soon as possible. That's what this whole stimulus package is about, and maybe the one behind it, based on some of the data we're seeing right now as to how businesses are snapping up that money. Hopefully in the next meeting, the next update, or the one after that at least, some of you will have started to get your checks, which I know that's another piece that will start to give people confidence and may actually help to buoy the stock market again. So I'm going to tell you some good news. 3 years from now, I think that CV-19 will only be a memory. I don't even think it's going to be something that we think about as a problem at that point in time. I don't know that, but that's my opinion. The reason I say that is we look at the last 25, the markets since 1928, 25 of those markets have been bear markets, 26 have been bull markets for the S&P 500. The average bear market has lasted 299 days, less than a year. The average bull market has lasted 1,003 days, which is more than 3 years. The 36% is the average loss in a bear market from peak to trough, versus 112% being the average gain in the bull market, trough to peak. 23% of the time since 1928, we have experienced a bear market. 77% of the time, we've experienced a bull market. And so the reality is that as we're going forward, I believe we're going to experience the same. Even though this is a unique situation and none of us experienced the Spanish flu of 1918, the reality is that pandemic had its ability to come back out of that, and I think this one will as well. How it comes together, I think there's a lot of pluses. One, the government didn't step in and do the things it's doing now. There were no resources. People were on their own. And a lot of people, the numbers are staggering how many people died during the Spanish flu. I don't think we're going to be anywhere near that. So all those pieces come together and give me hope that by at least 3 years from now, and maybe sooner, we're going to recognize that this was just another terrible event regarding the health and death of many people. But from a financial viewpoint, we will actually be able to move on and maybe move back to where we were pre-CV-19. Until then, though, we all have to be wise, safe, well, and smart. And that brings me to the next thing I wanted to kind of share with you today. One of the things that we talk about in planning is to set SMART goals. SMART goals are specific, targeted for a specific area of improvement, measurable, quantify, or at least suggest an indicator of progress. It needs to be assignable, specify who will do it. It needs to be realistic, state what results can realistically be achieved given the available resources we have to work with. And time-related, specify when the results can be achieved. Now you might say, why are you even talking about setting SMART goals today? It's really simple. When we are driving our cars down the highway, we don't sit and look at the white line passing on the road beside us. We look as far down the road as we can. If there is a big storm ahead of us, we still look as far down the road as we can. If we're in the middle of a big storm, we don't look at those lines on the side of the road, we look ahead. And my encouragement is that we go forward even as we're trying to put all this information together and we're trying to navigate this process wisely, that you and I need to focus on SMART goals, specific, measurable goals that we can assign to either others or ourselves to work on, realistically achievable, and a time model attached to it so we can be focused on the longer term, not the shorter term. And I assure you that if you focus only on the short term, it will just mess you up. But if you can focus on the long term, it will be better for you, and it'll be better for the decisions you'll make, and the end result will actually come out better too. So SMART goals. Work on thinking through that process. Don't get lost in what's happening today or tomorrow or the next day, but think about specific and measurable goals. Who's going to be responsible to get them done, whether it's me or Paul or you or somebody else. How do we get those done? And let's put together realistic goals that can be achieved in a time that we've modeled. And I think that will help make this time move faster and work better. And just for the record, I can tell you that's exactly what we're doing here. People I get on the phone and they're like, are you just worn out with everybody calling you? No, actually, I'm kind of energized a bit. I'm proud of you. You're all doing a great job. And I think there's a lot of opportunity here. And even in my own business, and I know Paul's the same way, we are thinking through what to do now so we move forward into the future with the best opportunities possible out of this. So some of the issues with the 2020 CARES Act, I shared with you some of the items last time having to do with the rebates, the RMD being suspended. We've covered a couple of other items. I want to hit a few more points that we didn't get a chance to talk about last time, and that is expanded unemployment benefit. The new law promises an extra $600 per week to workers on unemployment during the COVID pandemic and extends unemployment eligibility up to 13 weeks. So who qualifies for that? Well, workers laid off or furloughed because of COVID-19. Workers who quit due to COVID-19. And that is a unique one in the past. And honestly, if you quit for reasons non-COVID-19, you don't qualify. But if there's something happening at your workplace and you're afraid that COVID-19 is a problem and you quit because of that, and you can verify that, you can show that, you can actually qualify for these unemployment benefits. For workers who are caring for children or other dependents at home because of COVID-19 issues, self-employed workers unable to work because of COVID-19. So if you own your own business, it's just you, and you can't really work because of what's going on with the markets or the economy, due to COVID, you can actually qualify for unemployment. And then finally, workers who are scheduled to begin employment but cannot because of COVID-19, maybe sickness either in their house or them personally. And then the last one, individuals who are now the primary breadwinners because their head of household died from COVID-19. Those people also qualify. So again, as everything else we've seen on the 2020 CARES Act, they are working hard to create outside-the-box thinking to help people during a difficult time. All of this really connects back to trying to do everything that's possible to keep this economy moving forward, understanding that it's not just financial, it's the pain and the loss and the health issues of this, but knowing that we also have to have good economics after the fact as well. There's also a student loan relief program. This is a little less well defined, and I think probably if you have student loans, and I know that some of our clients do, you can check on this. But here's some of the issues to it. One, this program establishes a pause on all student loan payments while the country works through the COVID-19 challenges. Current details we know so far is this: your payments will automatically stop from March 13th through September 30th of this year. So if you're already on a payment schedule, they will stop the payment. You won't have to keep making that payment, and it should be automatic from all the institutions as listed here. Which loans these apply to: defaulted and non-defaulted direct loans, defaulted and non-defaulted FFELP loans, program loans, and federal Perkin loans. Those loans will all automatically stop. But for those of you who are in a position you want to keep paying because you're not forgiven these loans, this is not wiping that debt out, it's simply extending it. So some people might say, look, I don't want to extend it, I just want to keep paying. You can continue to make payments, but you've got to contact your loan servicer and let them know you want to keep making payments. Otherwise, it will just stop right where it's at. And I put at the bottom there, more details forthcoming as the program becomes implemented. It is a program that, honestly, I had trouble pulling information up on. I had to go through multiple resources to get details on it. And even some of those disagree with each other. So check with your lending institution if you have student loans and find out how they're operating with it. And then next, charitable contribution changes. For 2020, cash contributions can be deducted up to 100% of adjusted gross income. Previously, taxpayers could only deduct 60% of their AGI, or adjusted gross income, for cash contributions. And that was actually increased from 2018, which was 50%. But now you can, for at least for 2020, you can deduct up to 100% of your income for charitable contributions. Excess charitable contributions can still be carried over for 5 years. So simply put, if you made $10,000 and you wanted to give $12,000 away, you could take and claim the whole $10,000 and then carry the extra $2,000 on to next year. Another thing about this is the Act provides for a new above-the-line deduction for taxpayers who can't itemize deductions on the federal return, called qualified charitable contributions. The maximum amount is $300. Contributions must be made in cash and prohibited from being made to donor-advised funds or to 509(a)(3) plans. It's got to be in cash and it's got to be given directly. The supporting organization or charity that carries out this its exempt purposes must be an exempt organization for this to qualify. One other thing about this, the Act states this starts in 2020, but it doesn't give an ending year. So this might continue on for years to come, which would be a nice benefit for some of you, I know. So as I said before, there's more to the 2020 CARES Act. Some of it we're able to find easily. Some of it, it's still kind of a work in progress. The money's there. The process has been designed, but actually linking it from a government process to a free market process takes a lot of work. And so recovery rebates, we're about to find out in the next couple of weeks, those are those $1,200 or $2,400 for families, 500 for children's home. We're going to see how that works. I think it's going to work well, but we'll find out. The 10% additional, no 10% additional tax for coronavirus-related retirement plan distributions, that seems like it's going to be pretty straightforward. RMD being waived in 2020, I've already talked to 2 of you about that. I think there'll be many more as they get to understand that. We talked about unemployment, student loan relief, and enhanced tax benefits for charitable contributions. Next week, I'll hit changes to medical expenses, and I'm going to hit on a few of the provisions for business owners. We might have a separate COVID-19 update for business owners only, and we'll update you on that as soon as we know for sure how we're going to do that. So as I've shared with you in the past, I know many of you have taken advantage of the Riskalyze calculation program that we use. Basically, it's just a way for you to score your risk when it comes to your investments. You can compare what your risk tolerance actually is to how your investments are set up. And so if you would like to utilize the Riskalyze link, all you have to do is send us an email and say, hey, I'd like to do that. Again, as I said before, we've had a number of you who've done it, and we're starting to meet with you to kind of review that risk-reward conversation. If you have not had a chance to do it and want to, just email us, and we'll be happy to give you a link so you can do the calculation, identify what your risk tolerance is, and then we'll have that conversation with you. So in review on those items, we talked about the economic perspective. We talked about COVID-19 and its potential impacts. We talked about the 4 phases to get back to normal, market recovery types, the economic and market considerations, the cyclical nature of investing, diversified wealth management, SMART goals to make the most of today for tomorrow, and the 2020 CARES Act update, as well as the risk-reward calculation through Riskalyze. Now what I want to do is I was asked a question. And again, if we had more questions, we would have included those. But we only had one question that I didn't answer in last week's update, so I'm going to do it now. And one of our clients, Sonia, sent a question and said, will we retest the March 23 lows? And so I thought we'd spend a little bit of time on that tonight because it will kind of give you a little understanding of how we look at various aspects of market decisions, especially when it comes to entry and exit strategies. Now, I know right now some of you just tuned out because this graph is so busy. It is incredibly busy, and I apologize for it. But this is what we kind of look at to help make decisions. So now let me just share with you. First of all, we're looking at the S&P 500 ETF from SPDR. I do it because it gives better volume information I can get from the S&P index itself. And we're comparing it. This very jagged line is the actual daily activity of the S&P 500. And you can see how it tracked down. What you'll notice is on that downward spiral, all the highs are lower, as well as all of the lows getting lower. And on March 23rd, I think, we hit our low on the market, and this was where it kind of bottomed, then turned around and headed up. And so now we're watching on the upside where we see the highs getting higher and the lows getting lower. But we only have just 2 examples right now, and so it'd be nice to see more, and I'll explain that in a second. From the top, from the peak, remember I keep talking about peak 12 and 6, from the peak, it was a 34% drop in probably one of the fastest market drops we've ever seen. And then from the bottom to where we are now, which I don't think is the peak, but it is from the trough to where we are at this point, it was a plus 21% increase. Now, as we look at this, the question is, will we retest this price down here, this bottom of the market? Will we retest that? The answer is we don't know. I will tell you that I'm a 75-25 that we will retest it, that we will hit that number again and test it to see if it holds. I'm also a 25% that it won't, and the reason I'm a 25% that it won't is because if we have really good news regarding how the 2020 CARES Act is implemented, if we have really good news about that, if we see people getting back out working faster, if we see the deaths lower quicker, if we see the number of those infected with COVID decrease, all those pieces are going to change this. But we don't know all of that yet. If, on the other hand, some of those pieces fall apart and don't work very well, I think it's much more likely that we will retest that market low. I don't know which way it's going to work. And so since I don't, that's why I'm saying I'm 75% that we will retest it, 25% that we won't, because what we're looking at is various aspects of things that we don't control that can cause that. I will also say that while I am cautiously optimistic at how well the government's doing right now, I also realize I'm dealing with the same group that makes it so uncomfortable to get my license, driver's license taken care of. I got to walk in the post office and I dread it. The reality is the government's not the most efficient. And so some of those pieces make me wonder what that's going to look like. And we're not going to know any of that until we get probably 2, 3, 4 weeks out. Also, I don't know if the death estimates and the infection estimates are accurate. And that makes me feel a little uncomfortable with that as well. So the answer to the question is I'm 75-25 when it comes to retesting that. But I'm going to tell you, I don't think that's actually the biggest question. I think a better question is what happens as we move through the markets over the coming months, because I want to share something with you. So these lines here, now I told you this is the daily activity, but these lines here, the blue line, this is, if you can see it on your screen, this is the 50-day moving average. And what that means, a moving average is simply this. It takes today and the last 50 days and it plots it on a graph. And then it rolls it forward one day and then takes that day and moves it forward one day, but still another 50 days and plots it on a graph. And what you'll notice is it's a much smoother graph than what this is. That line is much smoother. The red line is an 80-day moving average, meaning that it's a longer average, meaning that it moves a little slower. And you'll notice that it's doing exactly the same thing, rolling 80-day models every day, just moves forward one day, and the last day pops off. But you'll notice because the 50 is a faster moving average, then it breaks through the 80. And this is a very important piece of information right here. This breaking through is like an early warning that something's about to happen. Now you say, wait, it's not that early because this is like almost 3 weeks out. That's true, it is. But normally it's not this sharp. That's one of the reasons why this was such a rapid decline and it took a while for things to catch up. Now this green line is a 200-day moving average, just like the other two, except instead of 50 days or 80 days, it's spread out even longer, a 200-day moving average. And you'll notice that it is, while it's turned down, it's even slower because it's got so much data to make it turn one way or the other. You'll notice the 50 has broken through the 200, and that now we have this point of what's called convergence divergence. That convergence divergence, which is just a fancy way to say it either converges into and diverges below it, or converges into and diverges above it. It's an early warning thing, because what would have been really nice would have been if it came down here and then kind of scraped across the top of it and then turned around and headed back up. Well, that would be a function of this moving up much faster. We see, though, interestingly enough, we are probably within a couple of weeks of the 80 and the 200 converging. And all of this information begins to add weight to it. And here's why it does. Notice this line here, the daily activity, and the 50-day moving average, they are like on a collision course. We can't see far enough out when it's going to happen. But when it happens, something interesting is going to happen. And that's kind of intuitively obvious, but if you think about it for a moment, it's going to hit the 50-day moving average, and it's either going to break through it and go up, which is a yay sign, or it's going to hit it, and it's going to turn around and go back down again, which is a sign. We don't know. And that, honestly, will happen long before we come back and test this low from March 23. This will tell us faster what's about to happen. As the 80 comes through the 200, as the 200 continues down, as the 50 runs into the daily activity, those are pieces we're looking at long before we're trying to figure out about the testing, because all of this will tell us. If we keep having good information that we're liking, that the markets are liking, that investors and institutions are liking, you will see this continue on, and you can even kind of imagine that's that V shape right there. But it may well be that it's going to bounce around here a while, come up, hit the 50, move around. These are all pieces of information that we look at for entry and exit strategies to decide what to do next. We don't have that information right now. So with that in mind, we've got enough things to look at here for the next few weeks to make that decision. One other thing on this chart that's important to notice is the amount of volume, how many transactions were happening. You can see it was amazing the amount of transactions that were happening. Well, they've died off a little bit. So what that means is that while there was a lot of activity, probably being sold from automatic programs from mutual fund companies or retirement plans or pension plans, a lot of that was just kicking out automatically. We're seeing less of that now. Notice some of these lines are red and some of them are green. So the greens mean there's more buyers, there's more upside, I'm sorry, not upside, but more positives than negatives, in that even if it goes down, there's more positives or negatives. And so what we're looking for is more of those. Also, when the V really starts to kick in, whether that's in June or July or September or December or January, whenever that happens, you can see a significant amount of volume happening there as well, which will then, if we're having positive volume, will drive this through the ceiling rapidly. That's where you want to be involved, and you want your accounts to be invested, because this data is all showing itself as entry points, not exit points. I'm going to spend more time once we get further down the road on this, kind of sharing with you what we're seeing with that. But the question, being a good question, will we go back and retest this? Probably. Will we break through it? I don't know. If we break through it, it means we're going to go a lot lower, back to convergence, divergence. We break below this. This has become, here's another fancy term, this has become a floor of support. Now, in truth, before we get to this, this has become a floor of support. And what that means is this: when the market breaks through it, everybody starts to go, uh-oh, this could be bad. And so it pushes it down. Up here, this becomes a ceiling of resistance. It takes energy. It takes more buyers than sellers on any given day to kick it in gear. And when that happens, it has to be implemented. It has to be put into place where the markets see it as an opportunity to buy more shares. So what we're looking at here is technical analysis. Technical analysis is simply a thermometer telling us what's going on technically with an industry or an index or a particular stock. And we can run this on all kinds of securities, whether they are bonds or stocks or commodities or even cryptocurrency. This is technical analysis. Fundamental analysis is looking at the economy as a whole, trying to glean from the fundamental information what we think is going to happen with the technical information. And so here's some information on that as well. Currently, what we know is Treasury offerings are moving higher. That means the Treasury bonds, the 10-year and 30-year notes, they're moving higher. People are buying those. Now, in some cases, we actually had a day today where they didn't buy as many. But normally, so far, they're moving higher, meaning they're buying more of them, primarily because it's an indication of concern about future growth. And so Treasury bonds feel safer, and so people do that. The dollar is down slightly, which means that as far as the world goes, they're kind of looking at us saying, how are you going to do? Because we're reporting so many illnesses right now, so many infections and deaths. But I think as that turns around, that will change. Commodities are near 2-month lows right now. What that means is that people think that people aren't going to be buying stuff as much anymore, that they're going to slow down, which probably is reasonable. If we're all staying at home more, we're probably going to buy less stuff. Every sector, every industry right now is off. All the major industries are off. Staples, meaning regular consumable stuff, and healthcare, they're currently the best performers in the group. Consumer discretionary was the 4th best. And I was talking with Paul about that. I think it's interesting because I think what that means is discretionary, meaning they don't have to buy it, is because everybody's at home buying on Amazon right now, or they're buying on online stores because they're buying stuff because they're bored, which I think is why that is, but we'll find out here in another month or so if that's actually true. Oil is significantly lower due to low usage because everybody's staying at home and the supply bidding war that's going on between Russia and the Saudis. Those two pieces are coming together and they are driving oil and energy lower, which is a whole nother set of problems. Quite honestly, outside of coronavirus, this by itself could be problematic for a recession. And then next, real estate is significantly lower. That means retail, office, industrial REITs will likely have a terrible quarter as tenants are unable to pay rent or struggle to pay rent. And then mortgage-backed investment REITs are experiencing a significant amount of volatility right now. And so because that means real estate and energy and commodities are all lower, all are indications that we probably are going to head into a recession, which isn't surprising. The question becomes how much of a recession, how long, and how deep it is. With that in mind, the markets are still predicting the recession. I told you I'd share this with you. Analysts right now are expecting the S&P 500 to report a year-over-year 5.2% decline in first quarter earnings. We've been typically looking for 15 to 25% growth, and so a negative 5.2 is not going to be happy, but probably that's priced into the market. The next quarter, they're estimating a 10% decline, which may be priced into the market. We'll find out. And then they're predicting a 1.1% decline in the third quarter. I personally feel that's a little low, but I can't tell you anything more than just my personal opinion on that. But if it's somewhere in that area, that probably is priced into the market as well, but we will find out. Again, more information every day. Knowledge is power. More information makes it easier to make these decisions. So now, with that in mind, hopefully that helped answer Sonia's question. It's probably a little more than what y'all wanted, but I wanted to share that with you because it kind of leads into some other stuff I want to be teaching in the next few updates. So now I'm going to go ahead and take a look here at the chat and see if we have any questions. Looks like we have just in here. Okay. Mortgage rates going up. Yes. Probably not. You know, the fact is, because the Fed is working so hard to keep velocity, to keep rates low, they probably will go down. We've actually had a couple of clients who had to refinance or were buying property. I talked to one who's buying property today. And they're getting pretty decent rates right now. Will the rates go up? I don't think so, but again, it's going to be based on a number of factors. I don't think inflation is going to go up right now, so I think that will help keep interest rates down. I think certainly the Fed is doing everything in their power to keep rates down because that makes it easier to keep the velocity, the speed of money moving, because with an economy that 40% of businesses aren't participating in right now, 40% of the economic capacity isn't being taken advantage of, you need to keep the economy going so that we can take off again. Think of it like this. If you were driving along at, I know none of you would do this, you're driving along at 100 miles an hour and you let off your accelerator, you drop to 60, you're still moving. But to get back to 100, you're going to have to use a lot of gas to get back up to 100, especially if you want to do it fast. And so that's kind of what we're facing here. So hopefully they'll keep interest rates low to make that work better. All right, well, that's the only question for now, but as Sonia did, any of you can certainly email us questions, and we will go through those at our next update. If it's something I can bring to the table then, be happy to do so. Thank you, yes. So Paul's reminding me that when we did our first update, we did it at 6:30 because we figured a lot of you'd still be working, and you're not now. So I know that a few of you are. I'm working, and I know a few of you are too, but many of you are at home now. So we're going to move the next update to 5:30, so that way we can be done a little sooner and you can be done a little sooner. So that's a good point. We'll be doing that at the next update at 5:30. We will continue to share new information as well as how we are reviewing things and kind of keeping you up to speed on that and taking advantage of opportunities. And again, if you have any questions, please feel free to email those to us. We'd be happy to do that as well. So in closing, thank you for your time. Enjoy your evening, and please be safe, be well, and be blessed. And I will look forward to talking to you soon. And if you have any questions or want to use that risk life, email us or feel free to give us a call. We'll be happy to spend time with you to answer any questions you have. Have a great night, and we will look forward to talking to you soon.